Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about a topic that I think is very useful for a lot of traders, whether you are a beginner or an advanced options trader, to get a better understanding of the mechanics of entering an options order, specifically around how do markets work in terms of how do you determine what the bid ask price is telling you, where do you place your orders within that bid ask price? Should you be trading below or after, below or above the midpoint? These are all questions that, regardless of what type of trader you are, you likely have some questions around it. So today what we want to do is take a deep dive into what you're actually getting in terms of information when you see a bid price and an ask price on your screens, and how should you use that for your options orders to maximize your positions. So with that, let's go ahead and get started. What we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So today what we're going to do is we're going to cover a few different things, but predominantly we're first going to talk about opening options positions, specifically regarding, for those of you that are relatively new to options trading, how do you go about entering an order? Because an order entry for an options position is substantially more complex than the orders for a stock trade. So we want to make sure that everyone understands how to enter those orders. Then we'll talk a little bit about, once you have an open position, how do you make sure that you close that position so that you are familiar with how to enter and exit your positions. And then what I really want to spend some time on is talking about option order pricing. So many times on your screen, you see a bid price and an ask price. What do they actually tell you from the respect of the market? And how do you use that to better gauge the liquidity of an option? A lot of investors are concerned about liquidity, but we tend to find most investors are looking at the wrong metric to gauge liquidity. So today we want to talk about what are the right metrics to gauge liquidity, and how do you access the tools and reports that we create here at OptionsPlay to give you a sense for which stocks or which options are most liquid and which ones you might want to avoid from a liquidity perspective. Then we'll talk a little bit about managing options positions, and then open this up for Q&A here at the very end. Now, I just want to make sure everyone can hear me loud and clear, so please type 1 into the chat window if you can hear me. If you're having some audio issues, I do suggest that you either dial in or potentially use the change your headphones, but it looks like the audio is working for most investors. But the primary question that I want to help investors walk away from this webinar here today is understanding what are the best practices for entering and exiting your options positions, so that you can maximize your potential profit and minimize your potential loss on each trade by better understanding how to enter your orders, and more importantly, understanding liquidity, so that hopefully you're able to get the best possible execution price on your trades. Now, my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I'm going to share with you my 15 years of trading experience in this particular market as to how professionals, institutional investors, and how market makers view the other side of the trade, to give you a little bit more context into how you can maximize your options orders. So let's go ahead and first get started. Now, with any options orders, when you're trading stocks, it's pretty straightforward. You can either buy the stock right now and sell the stock later, or you can short sell the stock first and then buy it back later to close out your position. Now, when you're trading options, what you have to specify on an options order ticket is whether you are opening up a new position or if you're closing an existing position. When you're trading stocks, you don't have to do this, because in stocks, it does it effectively automatically for you. So if you buy 100 shares today, you sell 100 shares tomorrow, it'll naturally offset the long position with the sell order. When you're trading options, because you're trading a specific contract, because you're trading contracts, when you're either buying or selling an option contract, you actually have to specify within the order of your options trade whether this is an order to open a new position or this is an order to close an existing position. If you screw this up, meaning if you enter the wrong order, if you enter buy orders as a close order, they will simply get rejected. However, if you enter a closing order and you don't specify that it's to close and you accidentally enter it as a brand new order, what you end up with is two separate positions. They might be offsetting to each other, but you'll end up with two positions as opposed to closing out your existing one. So it's really important, especially for those of you that are relatively new to options trading, to know how you're entering your orders. Now, this isn't really complex, and it's pretty straightforward because you have entry orders and you have closing orders. Now, just like stocks, you can either buy first and sell later, or you can sell first and then buy back later. So that's still the same. The only difference is that depending on whether you're opening or closing, you have to specify whether it's a to open order, so either buy to open or sell to open. Now, depending on whether you're trading a debit or a credit, this will determine whether you're buying or selling to open. And then when you're closing it, you effectively have to do the opposite transaction. So if you're buying to open to enter into the trade, meaning a debit trade to get into the trade, then you have to sell to close at the closing transaction. And whenever you trade initially for a debit, you will always have a credit to exit, and vice versa. If you sell to open initially for a credit, then to close that position, you would have to buy to close later for a debit. So it's always just the opposite transaction. And the most important thing to remember is that for any option strategy, you must specify whether it's to open or to close. If you get the wrong one on the open side, this order will simply get rejected. But if you do a buy, let's say buy to open, and instead of getting a sell to close, you accidentally do a sell to open, what you'll end up with is an initial position, and then you'll end up with a second position here at the same time. So instead of closing your position, you'll end up with two positions, and that's obviously not what you want. So not difficult to remember, not difficult to do, but it's important to remember this, especially for those of you that are relatively new to options trading. So let's talk a little bit about establishing a new position. First of all, whenever you think about trading options, you must first have a directional view on the underlying stock or ETF that you're trading options on. This could be bullish view, bearish view, or even a neutral view since when you're trading options, you can have a neutral view and actually profit from a stock staying relatively still. So once you have that directional view, you must first select an option strategy. So are you buying a call option? Are you selling a put option? Are you trading a vertical spread? Are you trading a diagonal? Whatever type of strategy you choose that fits your directional outlook, you then have to select an action, which is what we just talked about in the previous slide, whether you're buying to open or selling to open. You have to choose the quantity, the number of contracts, the expiration date of the contract that you're trading, the strike price of the contract that you're trading, and then the call, whether you're trading a call or a put. And then lastly, you have to enter a price. So what you see here is that immediately right off the bat, when you're trading an option strategy, there are a few additional parameters that you have to think about that you didn't have to remember or think about when you're trading stocks. And that's predominantly around the strategy, around expiration date, strike price, and call put. These are all new things that you need to think about when you're trading options. So you have new parameters that you need to enter on each options order strategy. And make sure that all of these, whenever you're opening positions, they must be a to open order. And you can enter these orders either as a limit price or a market order. And this is dependent on just like your stock positions. You can enter a market order to get filled immediately at whatever the market price is, or you can place a limit order, which basically says that I want to get filled at this price or better at some time in the future. So just like a stock trade, you can specify how you want that execution to execute. Now, when it comes to multi-leg orders, this is really the part that many, especially newer options traders tend to send me this type of question, is really, when I have a multi-leg option, should you enter it as a single order or should you enter it at multiple legs? And the answer is you always want to open order. You always want to enter a multi-leg option in a single order. You never want to break it apart. Now, I know some investors here will say, my broker doesn't support multi-leg trading. I can only do them as single leg. From my perspective, I think that if your broker only provides single leg execution, you might want to take a look at some of the other brokerage firms in Canada that offer multi-leg execution. I, as a trader, would never recommend breaking apart a multi-leg order and working the execution separately. You have execution risk. You have the potential of being executed on one side and not executed on the other side. You may have trouble getting out of one leg. In certain scenarios, you have to get out of one leg first before you can get out of the other one. So if, let's say, you're trying to trade near the close, you might be stuck in a position where you're long one leg but out of the other leg. There are just too many scenarios, in my opinion, that I don't recommend breaking up a multi-leg order into separate legs. Some brokerage firms offer the ability for you to call in a multi-leg order. If that's an option, I encourage you to pursue that. But for those of you that are trading at brokerage firms that don't support multi-leg, I highly recommend that you consider looking at some brokerage firms that do support those multi-leg options, because we do not recommend breaking them apart. So entering the order, like I said, there are a few extra parameters. You have to consider whether you want to do a limit or a market order. And then when you're ready to close that position, whether it's at a profit or at a loss, what you generally want to do is you want to set rules before you get into a trade. So when I'm entering this trade, so let's say in this particular case, I'm looking to buy one contract of the November $94 call options, and I'm paying $2.66 for that call option. What you want to do before you get into this trade is already have a predetermined target price and a stop loss level, which means that, and generally speaking, as far as when you choose your stop loss and take profit levels, that's depending on the strategy itself. In this particular case, this is just a call option. The rules for it are relatively straightforward. You usually want to cut your losses at about a 50% loss. So if you paid $2.66 for something and it's declined to about $1.33, that's time to potentially get out of the trade. If, let's say, you've paid $2.66, we usually look for about 100% gain to start taking profits on that trade. So that would be $5.22. Is that right? I'm blanking out right now. $5.216. No. 630. No, 532. I don't know what's going on with me today. Let's do this. This will be much easier. 532, right? Okay, got it right. So it's $5.32. So what I usually have rules for before I get into a trade is to know that if I'm going to get executed at this price, if I'm going to execute it at this for $2.66, then I know that once this call option reaches about $5.32, that's about time for me to take profits. And if the trade goes down to about $1.33, it's time for me to cut my losses. These are things that I determine before I get executed on entering the positions. And I highly recommend every investor, when you're trading options, to first think about what your potential outcomes are before you get into a trade. You should have a plan before you get into a trade. If you're figuring out your plan after you get into your trade, in my opinion, that's already too late. You don't want to do it after you get into the trade. You want to do it before you get into the trade. So that once you've placed that trade to enter this trade, you already know when you're going to exit this trade. And what that does is it removes some of the emotions that we generally go through when we're trading options or trading in general. We know that as the market fluctuates, sometimes the trade goes in our favor and we panic and we say, okay, maybe I take profits, and you take profits too early, or maybe the trade goes against you immediately and you're not sure what to do and you're holding on to the trade and you're hoping that the stock comes back. You never want to be in that position. You should have rules that should be set up in place before you get into a trade. So if it triggers that stop loss level, you've already emotionally have prepared for that, and you know, okay, when it gets down to about $1.33, I'm going to cut my losses and move on. Set these rules for yourself. That's how you're going to be able to prevent these huge account blowups that many investors unfortunately have in their accounts, because they simply trade too large, and when the trade goes against them, instead of cutting their losses, sometimes they even throw more money at the trade, hoping to get themselves back to break even. This is what I mean by trading without a plan. This is what ends up happening many times when you don't have a plan. So this is why I always recommend, before you get into trade, know when you're going to get out before you get into that trade. And then once you have a position and you're ready to close that position, most brokerage firms allow you to select the position that you currently hold and have a button that will usually be something along the lines of close my position. And what that typically does for most brokerage firms is that it will pre-fill an order ticket for you. And this is designed to basically prevent you from opening up a second position as opposed to closing your first position. Like I said, because there's so many parameters with it when it comes to entering your options order, you need to make sure that you enter the correct position or correct order. Most brokerage firms have a close feature that basically pre-fills the ticket for you, so that you are definitely going to be closing a position. And just like an open position, you can either select a limit order or a market order. A limit order is specifying a specific price that you want to be filled at or better. A market order will get you out at whatever the current market price is, regardless of what price you get. It'll guarantee execution, but it does not guarantee price. And lastly, whenever you're thinking about if you currently hold a multi-leg order or multi-leg position, you always want to make sure that you enter an order to close both legs at the same time. You do not want to leg out of your multi-leg order. I get questions from investors sometimes asking me, can't you make a little bit more profit if you leg out at different times? And the answer is absolutely. If you're extremely tactical and you get the timing correct, you can make more money by legging in and out of a vertical spread. But you're opening up yourself for substantially more risk. And from my perspective, I don't think that risk is worth the extra maybe 10 or 15 cents you might be able to make from breaking apart a multi-leg order or a multi-leg position. So that covers kind of just the basics of entering and exit an options position. Now, the part that I want to spend a bit of time on is understanding the bid and ask price, because whenever you're trading options, you're going to notice that there's a bid price and an asking price. And I want to talk a little bit about what these mean and how you should use them to determine what information does this actually provide you with when you're looking at that bid ask quote. So the best way to think about it is any type of market, whether we're trading stocks, options, mutual funds, futures, doesn't matter, any single asset class, any single financial instrument will always have a bid price and an asking price. And the way to think about this is you should think of every single market as one huge auction. And what we're auctioning off is a specific security, whether that security is a stock or a specific option contract or a futures contract or a currency, it doesn't matter. It's all markets are effectively one large auction. And what the bid and ask price is telling you is simply what the highest price someone's willing to pay and what's the lowest price someone's willing to offer you for a specific asset. So for example, when you see that in reality, the markets only have two prices. They have a bid price and they have an asking price. The bid price effectively tells you what is the highest price someone is willing to pay for a specific asset. The asking price is the lowest price someone's willing to offer for that same asset. So the way to think about this is no different than perhaps a house, right? So think about when you put a house on the market, you always have the seller that has the lowest possible price that they claim that they're willing to take, and then you have bidders or buyers who have the highest price they're willing to pay. And always that number, the buyer obviously will always want to put in a lower offer than what, or a lower bid than what the seller is willing to offer at. And that's how we get a bid and ask price. So whenever you look at an options quote, right? Whenever you look at your options screen, whether you're looking at stock quotes or options quotes, there's always a bid price and an asking price. What that's telling you is, out of all the possible limit orders out there, what's the highest limit order out there? Who is willing to pay the most for this asset? And then on the flip side, who is willing to offer the least amount of money to sell this particular asset? And what that allows us to do is calculate a mid price off of that price. And the mid price gives us a sense for what is the asset truly worth. Does that make sense? Just like how you can have $1 million house where the seller wants 1.2 million for it, but the buyer only wants to pay $800,000 for it. And because houses are not very liquid, we can use the offer price versus the bid price to give us a better sense for what is the house really worth. And that's what we're really doing when we're looking at the mid price, is we're basically saying, what's the highest someone's willing to pay versus what's the lowest someone's willing to offer, and we calculate the midpoint from that, and that gives us what we have is an implied fair value for any security. So what we basically are saying is that by looking at the bid-ask prices, we can get a better sense for what is the asset truly worth. And then this gives us an understanding as to how much is the markup that the seller is asking for, and how much of a discount is the buyer trying to get when they're buying for that asset. So when you start to think about markets from an auction perspective, or similar to an auction, this is the type of insight that you start to gather from the markets. And this is going to be important for a lot of different reasons, because number one, you want to know what is the fair value of something, right? Regardless of what the bid-ask quotes are, I want to know what is something actually worth? What is the fair value of something? And the second thing you want to know is how much of a markup are participants in the market trying to charge me to buy and sell this specific asset. The higher the markup, the worse my performance is going to be. The smaller the markup, the better my performance is going to be. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Because a lot of investors think about bid-ask prices, in my opinion, in a different way. But in reality, the best way to think about it is really think of it as like the markup off of an advertised price. So imagine, think of the mid price as kind of the true price of something, and think about the bid and ask price as the sticker price that someone's is trying to advertise on the open market. So think about a used car lot. When you walk into a used car lot and you try to sell them a car, they're obviously going to offer you a very low price. And then when you go into the used car lot and you try to buy a car, they're going to charge you more than what that fair value is. And you have to figure out and negotiate your way to that fair value. Here, when you trade any financial instrument, you already have those quotes. That's what the bid-ask quote is telling you, is roughly what the fair value of that asset is, and roughly how much of a markup buyers and sellers are trying to charge you to buy and sell that specific asset. So that is the most important thing that I think investors need to learn as to what the bid-ask price is telling you, because that's going to give you a lot of insights into where you should place your orders, and also gives you a lot of insights into how liquid something is, how actively traded something is. I get a lot of questions from investors looking at open interest and volume. That gives you very little information, in my opinion, as far as the liquidity or what buyers or sellers are looking for. The bid-ask quote tells you a whole lot more in terms of information. So when we talk about a large cap stock, a stock that's very widely traded, especially stocks that are less volatile and trades less volatile, these are trades that are most widely traded. What you're going to see is that, number one, the markup on the fair value is going to be relatively small. Why is that? It's because there are lots of buyers and sellers. So if I had a really large, if I as a market maker put on a very large spread and I marked it up by a whole lot, guess what? all my other competitors, all the other market makers, all the other market participants in the market are going to place quotes inside of my advertised price. So for me as a market maker, for me to attract any order flow, I'm going to have to tighten up my spreads. I have to mark up the asset by a smaller amount in order to stay competitive. That's why more actively traded, more large cap, and specifically less volatile names will have a tighter bid-ask spread than something that's maybe a small cap name, maybe something that's more volatile, or something that's just more thinly traded. There's going to be less competition. So as a market maker, whatever the fair value of the option or asset or whatever it is that I'm trading is going to be, guess what? I'm going to ask for a much larger markup because there's a lot less trading in this particular name. There's a lot less competition for order flow. So I can place my quotes all the way out here and no one's really going to come and compete with me. So I can put my quotes out here. Think about like something that's not very liquid, like a house, right? You're naturally going to put on a much larger spread. You're going to ask for a larger markup on a house than you are on perhaps an iPhone that's predominantly a commodity. So if you have an iPhone that's worth $1,000, guess what? You're not going to be able to really mark it up by much because there are 10,000 other guys willing to sell the same iPhone for less than you. So if you're in the market of selling iPhones, you're going to be far more competitive in terms of your markup. Doesn't matter whether you're buying used iPhones or selling brand new iPhones. Your markup is going to be much smaller because there are a lot more iPhone dealers out there than someone selling, let's say, a used car or a used home. So you can use that same approach to better understand how market makers are thinking about this. And this gives you a little bit of insights into the someone who's on the other side of the trade, because guess what? Your bid and ask quotes, where is that coming from? That's coming from a market maker. A market maker's job is to, by definition, always make a market on both sides. They are obligated to buy and sell from you a specific asset, and their goal and their only job is to create liquidity. So from a market maker who's trying to create liquidity, guess what? If they make their quotes too wide, they're not going to be attractive enough and no one's going to want to do business with them. They're going to go out of business. So market makers are constantly trying to figure out, just how much trading is being done in this specific name. If there's a lot of trading going on, they'll be much more competitive in their quotes and they're going to have a much smaller markup that they're going to charge you. And if something doesn't trade very often and there's not a lot of competition, they'll widen out the quotes. That's why bid-ask quotes are by far the most important indicator to give you a better understanding of liquidity than any other indicator. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. And I know a lot of investors tend to have questions around this in terms of how market makers work, and I'll try to get into that a little bit. But just think of market makers as computers that sit on the exchange that wants your order flow. And they're trying to figure out how far to mark it up to attract your order flow. They know that if they mark it up too far, they're not going to attract your order flow. If they put it in too tight, then they're not charging a high enough markup to make money. So they're trying to balance kind of their views as far as where there's enough liquidity and where they're going to be trading. And your job is to, from this, get a better understanding, number one, of what the true theoretical value is, and then try to get it at a lower markup than the advertised price. Because if you think about the asking price and the bid price, this is just the sticker price. That's like when you walk into a car dealership, and especially think of this as a used car dealership because that's like an auction market. Think about it. When you go into a used car dealership and someone says, this car is $10,000, that's a sticker price. Would you ever pay that sticker price? The answer is no. You're always going to try to negotiate and get closer to the fair value. You're never going to pay the sticker price. You should think of all markets the same way. The asking price is simply the sticker price. What you want to do is negotiate your way towards the mid price. The best possible execution that you want is the midpoint, because that means that you're paying the fair market value. You're paying zero markup if you get filled at the midpoint. And your job is to get as close to the midpoint as possible. Does that make sense? Please type 3 into the chat window if that makes sense. So if you're buying, what you're saying is that this is the advertised price, this is the fair value price, and my job is to get as close to this fair value as possible. And vice versa. If you're in the process of selling, if let's say you're now the seller, now what this is saying is that this is the advertised price that someone's willing to buy. You know that it's worth this much, so your job as a seller is to negotiate your way up to the midpoint. Does that make sense? If that makes sense, everyone, please type 4 into the chat window. I hope that this is a different view into how you think about bid-ask prices and what the midpoint is really telling you, because this is how institutional investors, figure out roughly how much they want to pay on whether it's a stock or an option. Stocks are obviously much more liquid and the bid-ask prices are much tighter, but when you're trading options, they're much wider. So you have to negotiate your way, just like when you go into a car dealership, especially when the markups are really large. Especially when the markets are really large, you want to do everything you can to get as close to that midpoint as possible. So don't let a wide spread discourage you. I tend to get a lot of investors that will say, oh, this thing is really wide, I'm not going to trade it. That just means that the dealer is putting on a very wide, a very large markup, because not a lot of people walk into their lot, right? So for example, think about like a Toyota dealership. They probably see a lot more volume than, let's say, a Maserati dealership. So a Maserati dealership is naturally going to have a much larger markup because they just see a lot less volume. They need to make up that lack of volume by having a larger markup than a Toyota car dealership that sees so much volume that they're going to have a smaller markup, and they make their money back through volume. So just because you have a wide spread does not mean that you cannot try to negotiate your way to the fair value of an option, okay? So that's why I always tell investors, look at the bid-ask price. Don't look at open interest and volume, because that tells you almost nothing about the liquidity, because the job of a market maker is to provide liquidity. So liquidity should never be a concern for you. The only question is, can I get filled at a price that's close enough to the fair value that I want? You might not be able to get that, but that doesn't mean there isn't liquidity, because there is liquidity on every single option series out there. That is the job of every single market maker. Their job is to create liquidity. So you can never say that there's no liquidity. There's plenty of liquidity. It's just a matter of whether the markup they're asking you for is too large for what you want to pay. Okay, so I know I've gone through a lot of, I know I've kind of beat this a little bit, a lot in terms of this concept, but I cannot stress how important it is for you to get a better understanding as to how market makers work. And this gives you a better insights as to how you can work your orders and get paid and pay as close to fair value as possible. Now, in the TSX, there are about 300 plus names that you can trade options on. From our perspective, when we look at liquidity, we see that there's about 50 very liquid symbols in the TSX out of the 350 something names that you can trade options on. So we publish this daily list every single day so that you know which names are most liquid in the TSX. And what we use to calculate this, is the bid-ask spread. We do not use open interest to gauge liquidity. A lot of investors still use open interest and volume. Do not, I repeat, do not use open interest and volume to gauge liquidity. Open interest only tells you how many contracts someone else opened up. That has nothing to do with your ability to get paid, to pay or get paid close to the fair value. Those two things have nothing to do with each other. However, liquidity is generally speaking a factor of the stock, meaning if a stock is very liquid, the options will be very liquid. If the stock is not liquid, then the options will unlikely be very liquid. So options many times may not look very liquid, but again, there's plenty of liquidity because that is what a market maker's job is to do, is to provide liquidity. That's their sole job. So when you see a bid and ask quote, that's liquidity. That's telling you I'm willing to buy and sell from you at these prices. So use that as an indication to give you, use the bid ask prices that a market maker is using to give you a better sense for what the fair value is so that you can get close to that fair value. Now, what you generally will also find is that many times you have wide quotes, but when you actually look at executions, they're filled usually with around the midpoint because investors know this. Investors are not stupid. They don't pay sticker prices the same way that you don't walk into a used car lot and pay the sticker price on that car. You negotiate. Same thing with an option strategy. You want to understand what the fair value is. That's what the midpoint tells you. And then what you want to do is you want to work your orders as close to that midpoint as possible so that you're getting an execution close to fair value. And don't be afraid to put orders inside the bid-ask spread. I see a lot of beginner investors or even experienced investors that will say, oh, there's no open interest in volume. I'm not even going to bother trying to place an order. You are doing yourself a disservice by not exploring that liquidity. So a lot of questions around, how do I determine liquidity? We publish a liquidity list. So when you log into your OptionsPlay tool, at the bottom of your screen, there's a link that's called liquidity. And what this does is it ranks all of the individual stocks within the TSX by liquidity. So as you go down the list, they get less and less liquid. The ones at the top of the list are the most liquid. So I don't think it's a surprise for most investors to see that Royal Bank of Canada, BMO, Canadian Imperial Bank, TD, these are the top names in TSX that have the most liquidity. This is something that you should be aware of so that when you're trading something, you should see whether it's very liquid, not very liquid, and if it's not on the list at all, those are the names that I generally would avoid trading options on, because if they're not in either very liquid or somewhat liquid, that means that they're not liquid at all, meaning the bid-ask prices are really wide and the chances of you getting filled at the fair value or close to the fair value are pretty slim. So those are the ones that we generally would avoid when you're trading options. Now, the other thing I wanted to hope to tell or hope shed some light on, I get a lot of comments from Canadian investors saying that the US markets are more liquid. And I've seen, when I first started doing this partnership with TSX back in 2016, on the surface, we kind of just took that at face value and we said, yeah, we know that the Canadian markets are a little wider, but we knew that some of the names were more liquid in the US, in Canada, specifically the banks and some of the energy stocks. But this year we actually did some analysis. We took all of the multi-listed options, meaning they're the stocks that are listed on both TSX and US exchanges. And we started to take a look at the markup that market makers were charging in Canada versus the US. And what we noticed is that the markup being charged in the US by US market makers on the same Canadian securities that were traded on TSX were substantially larger. The markup on the average spread on Canada was only 43 cents Canadian. And when we took the US spread and converted to CAD, it was over $1.03. So right off the bat, you'll notice that Canadian market makers are charging a substantially smaller markup. And again, this is just the advertised price. You can get filled inside of that advertised price. You never pay list price. You always want to negotiate your way to a better price. So the only difference that we noticed here was that simply the Canadians quotes were for smaller amounts of contracts that were available. However, the average contract size was 29 contracts by 24 contracts, which for most retail traders, I would, the average contract size is under 10 contracts per trade. So when you have access to tighter liquidity with markets that are deep enough, in my opinion, for most retail traders, even if you exceed that 29 contracts, even if you're used to trading 50 contracts at a time, you'll pay a little bit more, but I don't think you're going to be paying as high as $1.03. I think you're generally going to pay maybe 50, 60 cents Canadian on a larger trade than in the US, which has deeper liquidity, but that deeper liquidity is much wider. So this might be a surprise. And this is not just banking stocks or just energy stocks. There was about 90 symbols or so that we analyzed. This was all 90. This is an average across all of them. This is not just, the few banking stocks or the few mining stocks or the few energy stocks that are the big cap names here in Canada, but all the multi-listed options have a substantially smaller spread or the substantially smaller markup by market makers here in Canada than they do here in the US. So hopefully this illuminates, just exactly what market makers are charging in terms of that markup for whether you're trading a US or Canadian security. So let's talk a little bit about entering orders now. Now that we've learned all this information about about what bid ask prices are telling you, let's walk you through an actual trade and how you can use this information to minimize the markup that you pay on an option strategy. So like I said, when we're talking about buying and when we're talking about entering an option order, buy orders should always be placed in between the midpoint and the asking price, because the fair value of that option is 785. The advertised price is 795. So what you want to do is you want to pay as close to 785 as possible. That's why whenever you're buying, you want to place your order somewhere in between the mid price and the asking price. Now, how do you actually work this order? Most investors, what they'll do is they'll actually start their order at 785. They'll basically place an order at the fair value and see if market makers are willing to fill that order. The reason that we start at the midpoint, and most people will say you place your order at the midpoint, there's no chance you're going to get filled. The reason that we say that you want to place your midpoint, you want to place your order at your midpoint to start off with is, even though we are deriving the mid price as the fair value may not always be exactly 785. Sometimes that fair value may be $7.83 that the market maker has calculated, but they've chosen to mark up the asking price a little bit more than they mark up the bid price. So what happens is that perhaps the theoretical value, that the market maker has in his computer system is maybe $7.83. So sometimes when you place an order at $7.85, a market maker will say, okay, that's a 2-cent markup. I'll take that, and they'll fill your order. So sometimes you will get filled at the midpoint. So don't be afraid to start your order at the midpoint. The midpoint is not always exactly representative of the midpoint of the theoretical value or the fair value. It could be off by a couple of pennies on one end. So don't be afraid to place an order at the midpoint. Now, if you place your order at the midpoint and it just sits there for a few minutes and it doesn't move, that's when you then want to start paying a little bit more and seeing how close you can get to the midpoint without going all the way to the asking point. So, if these were penny names, then I would place my order at something like $7 and maybe 87 cents. If, let's say, at 7.85 it doesn't get filled. If that doesn't get filled, I'll move it a penny at a time, $7.88, $7.89 until I get filled. And what you're trying to do is you're just trying to get a price that's as close to that fair value as possible. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. Whenever you're buying an order, you start at the midpoint because that's the fair value, right? That's the best possible price you can pay. And what you want to do is you just want to go little by little closer to the list price until you get a price that it's acceptable. You generally do not want to go all the way out to the list price. Usually we'll have some kind of cutoff. I usually cut it off, I wouldn't go anywhere close to that asking price. I'll probably cut this off at $7 and let's say 90 cents. If I can't get filled at $7.90, I'll move on and maybe place another trade, because this is telling me that, there's not a lot of liquidity inside of the spread. I certainly don't want to pay the advertised price unless the bid ask price is really, really small, right? So sometimes you get something like, the midpoint is $7.85 and the asking price is $7.87, right? So on XIU or some of the really liquid banks, you might see a spread that's even wider, like $7.81 by $7.87. So, and sometimes in these particular cases where the spreads are only 2-3 cents, I might pay the asking price because I know that that's a fairly that's a fair price to pay. I'm only paying 1 or 2 cents above the fair value, but most of the time you'll see spreads that are probably 10 cents, 20 cents wide, sometimes even wider. So that's why it's so important to work your orders. So start at the fair price of the option and work your way out. Okay. Now, if let's say you were in the process of trying to sell this option, right? Maybe you own this option, or you're trying to sell a cover call, or you're selling a cash secured put and you're trying to sell this option, then again, you know that the midpoint's your fair value. The list price that someone's willing to buy from you is $7.75. That's the offer that someone's giving you, or the bid that someone's put in. And what you're trying to do is say, no, I don't I don't want $7.75. I want $7.85 for it. Place that order at $7.85, see if you get filled. And again, for the same reason, just because the midpoint's at $7.85 doesn't mean that the computer system that the market maker's using has the fair value at $7.85. Sometimes he has his fair value at maybe $7.86, but he's still going to place that market at $7.75, $7.96. So when you place that order to sell at $7.85, he might say to, the computers might say, okay, I'll take a 1 cent markup on this trade and I'll fill your order at the midpoint. But that doesn't happen very often, but it does happen from time to time. So always start at the midpoint and then slowly work your way out, okay? Now, on the TSX, about a quarter of the names, especially the most liquid names, they are penny increments, meaning you can trade these options at 1 penny increments. So you can move your order from $7.85 to $7.84 to $7.83. You don't have to trade them in nickel instruments. In more of the less liquid names, they trade in nickel instruments. So you have to go from $7.85 to $7.80, and the next possible price you have below that is $7.75. So in the penny names, you can move little by little and get filled at a much better price. So if you get filled at $7.83 instead of $7.80, that's 3 cents. That equates to $3 in P&L at the end of the day per contract. So if you're trading 10 contracts, that's $30. That can be a substantial amount of capital. So you really want to make sure that you use these tools to help you maximize your ability to get filled, because again, that can translate into substantial amount of dollars if you're trading even 10 contracts. Each penny that you lose is $1 that you're is $1. Trading 10 contracts, that's $10. That could be your commission on that trade. So you can potentially offset some of your commissions by getting a better execution in this particular way. So it's worthwhile to spend the time to work your orders, especially if you're trading more than a few contracts. It really comes back to potentially help you. So with that, that covers what I wanted to share with you. So just a quick review of this. Let's say I have a bullish trade on BMO and I want to buy the November $78 call option. So I go to buy to open the November $78 call option, and you see that the bid price on it is $254 and the asking price is $264. So what I can do from that is create a mid price here of $2.60. And what this allows me to do is to quickly decide where I want to place my orders. Generally speaking, as a starting point, I would start at $2.60 and work my way up. I would start at $2.60. Maybe if that doesn't get filled, move to $2.61, move to $2.62, and work my way up until I get filled. But usually if I get to $2.62 and I'm not getting filled, maybe I'll go to $2.63. But I certainly don't think I would necessarily go to $2.64. But you'll tend to find that, I think, in my opinion, that you'll probably get filled somewhere at $2.62. So you save yourself 2 cents, that $2 per contract, 10 contracts, that's $20. That can go a long way if you were able to do that on all of your orders. So that just covers, a basic understanding as to how markets work, how you can use the bid-ask quote to give you a better sense for liquidity, get a better sense for how market makers are thinking, and use that to your advantage to work your orders and try to get as close to that fair value as possible. Because if you can get it at fair value, then you're paying effectively no markup at all. And occasionally you're able to do that. So use that to your advantage when you have that opportunity. So with that, that covers what I wanted to share with you here today. Again, for those of you that have access to OptionsPlay, please access it because it provides you with a wealth of information. It provides you with a wealth of information to help you better understand how to analyze these option strategies. But we also have these liquidity reports designed to help you better understand where there's liquidity in the options. So that liquidity report here is at the bottom of your screen. When you click on that liquidity report, it'll bring up the liquidity report that, again, ranks every single TSX stocks by liquidity. So the further down you go, the less liquid the names are. The ones at the top of the list are the most liquid names. We also show you the next earnings date so that you're aware of when that next earnings is being paid. As you can see here today, there are 57 very liquid names that we see. And there are, let's see, 125 names on the total list. So out of the 300 plus names that you could trade options on, we think there's about 125 of them that are liquid enough to trade options. Outside of these 125, 100 names or so, that's where you start to lose that liquidity. The bid-ask spreads are really wide. You're likely going to have to pay a substantial markup be above the fair value in order to get executed on an entry or on an exit. So we generally do not suggest or recommend doing that. We think that there are plenty of names that you can trade within these 125. Stick to those, then you'll be able to get in and out relatively easily on your trades. So with that, that covers what I want to share with you here today. At this point, what I'll do is I'll open this up for Q&A. There is both a chat window and a Q&A session, Q&A window. Please type your questions into the Q&A window, and I will answer any questions that we have regarding this in that Q&A window. Linda's asking, is the mid price just the average between the bid and ask price? That is correct. It is just the average between the bid and ask price. Your filled price is always the spread of 0.05 at the time. You can't get filled at this price at 788, 785, 790. So Tony, there are penny lists, there are penny names. So there's about 25% of the 300 names that you can trade on TSX have penny increments, where they do trade in penny increments. Not all names are. You can go to the MX website. They actually have, if you go to the Montreal Exchange, if you go to equity derivatives, there's the penny pilot program list. This allows you to download the list of stocks that trade in penny increments. So you can find that on the Montreal website. It is here, it is right here, the penny pilot, penny program list. You can get the list of which names trade in 1 cent increments as opposed to 5 cent increments. How do I get free access to the OptionsPlay platform? You can sign up using this link right here, which I will post into the chat window. If you want free access to the tool, it'll give you access to the liquidity reports. You can access it using that link on your screen. I like to use the underlying price for stop loss and profit exits. What is the best way to estimate the option price based on the underlying price? Sal, you really can't. You can make some approximations, but many times those approximations will drift pretty far. You got to recalibrate those basically every single day. The best way to do it is the midpoint of an options price. You can do it on both, right? So you can set alerts from your broker firm to say, you know, alert me whenever the stock price reaches a certain price or stop level. But keep in mind that that doesn't translate into P&L on your options position, which is why you should always set P&L price targets based on your options position, not on the underlying stock. Will this presentation be recorded? Yes, this is all recorded. How do you follow the price? I'm not sure what you mean by that, Boris. What do you mean by how do you follow the price? The bid-ask price is available to you on pretty much any trading platform. Can you program a trailing stop on options? Boris, that depends on your brokerage firm. If you trade with a brokerage firm like Interactive Brokers, I believe they should have trailing stops on options. Most brokerage firms, I can tell you, do not offer trailing stops on options. It's just a matter of whether your broker supports the order type. Is mid-price always the average of the bid-ask or calculated some other factors? It's always the average of the bid-ask price. And the reason that we can use the mid-price, the average of the bid-ask price as a gauge for the theoretical value is because we know how market makers think. Market makers are not going to mark up one side necessarily much more than they mark up the other side. Well, actually, that's not 100% true. There are some scenarios where sometimes the asking price is marked up a whole lot and the asking price is marked up effectively 0. And then the asking price is, the bid price is marked up by a whole lot. There are scenarios of that, which is why I always encourage you to start at the midpoint and work your way out, because sometimes you'll get filled at the midpoint. Peter is asking, when I place a sell order for an option, if I enter the midpoint, the displayed ask price is instantly lowered to my asking price. Peter, correct, because you now become the highest asking price. So originally, the market maker had the lowest price that someone's willing to pay, and now you just became a lower price. So you become the new asking price. So, and if I lower my ask price further, the bid price will get lowered further. Peter, I know it may seem like, you know, someone's on the other side playing games, but I can assure you that there are millions of, I mean, not millions, there are hundreds of thousands of strike prices. No one's sitting there playing around with your orders, and when you place an order, someone's moving the markets. It just doesn't work that way. You can ask any market maker. It's all done by computers right now. And yes, sometimes they have a very, very large markup. And once you start to interact, they start to tighten their quotes a little because they know that someone's willing to trade. And they will move their prices around. But generally speaking, use the mid price as your guide and start working your way out from that midpoint. Barry's asking, hi, Tony, how quickly do option prices change during the trading day as the price of the underlying changes? Barry, I would say that it is within milliseconds because markets are made electronically anymore, are made electronically. There's no human being that reacts to the stock price and then changes the bid-ask price. Bid-ask prices are calculated off of the underlying. These computers do it pretty much within milliseconds. So it's virtually instantaneous that the option prices will change with respect to the change in the stock price. Otherwise, if they don't do it fast enough, another market maker is just going to come off and pick them off. So it's kind of like a cat and mouse game between market makers. You know, if you're too slow, then I'm going to take advantage of that because the underlying stock price moved. You didn't move your option quotes. I'm going to be able to trade with your option quotes and make money from that. So that's how you know market makers are really efficient because they play their cat and mouse game with each other with high frequency trading computers to try to outsmart each other. How can I do a poor man's cover call strategy? It's a multi-leg that requires selling single legs. So Sebastian, the cover call strategy is the only strategy that you can trade both legs separately. A poor man's cover call, you trade separately. Because you're not moving the long leg. It's not, from my perspective, a poor man's cover call is not a multi-leg strategy. It's actually two separate single leg strategies. Jeff, your question about how do I access OptionsPlay, I hope that I answered that for you. Can you look at BlackBerry and its liquidity? So Rai, you have access to the report. It's not difficult to use, but if I'm not mistaken, the symbol for BlackBerry, is it BB in Canada? Yeah. Whoops. BB is right here, somewhat liquid. It's not very liquid, and it's near the bottom of the list, which tells me that it is one of the least liquid names out of the 125 names. What is multi-leg? Armel, a multi-leg order is an order where you have perhaps a buy and a sell in a single order. So this is an example of a multi-leg order. I'm buying the November 66 puts, and I'm selling the November 5 puts against it at the same time. So entering those two legs as a single order, that's a multi-leg order. Jeff is saying, I trade on WebBroker, which allows me to calculate theoretical value for options. When I enter an order, should I start at the midpoint or the bid ask or the theoretical value? So Jeff, that depends on how your broker calculates theoretical value. I doubt that your broker, actually, I take that back. I have no idea how your broker calculates theoretical value. I would ask them. If it's a formula base, you should probably ask them how they're calculating theoretical value. If you have a true theoretical value calculation, I would use that as your starting point and work your way up. But know that the market maker's theoretical value will likely differ from what your broker calculates, because market makers usually have some pretty sophisticated modeling for this stuff. They certainly probably spend the most amount of time figuring out the best theoretical value calculations. That effectively is their intellectual property. Some brokerage firms do have theoretical value, but I've generally found that they're not particularly good. So I tend to use the midpoint, because I think market makers, generally speaking, will spread out the bid ask based on their theoretical value. So the midpoint usually is a pretty good representation of the true theoretical value or true fair value of an option. Liquidity, why not calculate IV rank like in the US market? Bruno, it really comes down to the lack of historical implied volatility data that we have here in the US. In Canada. In the US, there are plenty of sources that give us historical IV. Here in Canada, there are no sources for historical IV, and you need that in order to calculate IV rank. So we are working on that, but it's not something that we have here at the moment. Can the buyer exercise an option before expiration? So buyers always have the option to exercise an option before expiration. However, it never makes sense to exercise your call or put option before expiration. Because if I exercise the $6 put that I paid 46 cents for, this $6 put would only capture me 4 cents in value, because I'm basically able to sell the stock at $6 that is currently trading at $5.96. That grants me a 4 cent profit, but I paid 46 cents for it. So why would I pay 46 cents to make 4 cents? That makes no economic sense, which is why it almost never do buyers exercise a call option or a call or put early, because I can make more money selling the put than I can exercising the put. Bruce, if I sometimes see an options trade get even better prices than my limit, why is that? That comes down to what we call price improvement. So let's say you are, I think this is probably a better example. Let's say the theoretical value of an option is $10.80, and you place an order to buy this at, let's say, $12. And you say, I'm willing to pay $12 for it. Sometimes you'll see you get executed at $11.95. Why did the market maker take your order and fill you at $11.95? It all comes down to the fact that brokerage firms track what they call execution quality, and they basically determine who they send their orders to based on execution quality. So when a market maker improves your order ticket on something like this, where they're saying, okay, I'm already making a large enough markup here, right? So on something like $12, a market maker might say, okay, I'm already making $1.20. Guess what? I'll give up 5 cents of that $1.20. I'll make $1.15 instead, because what that does is it improves my execution quality score with the brokerage firm. And that puts me in better graces with the brokerage firm. And the brokerage firm is likely going to send me more orders in the future. So it's all a cat and mouse game of trying to charge you the largest possible markup possible, while improving your prices enough so the brokerage firms see that the market makers are doing something to give you better execution, and this in turn incentivizes the brokerage firms to send their orders to a certain market maker versus others. So a market maker that constantly gives their clients price improvement, they're going to probably send more orders to that market maker. So this is really just how some of the sausage gets made on the back end, if you will. David, can you explain the number of options versus the number of contracts, please? I'm not sure what you mean by the number of options. Let's say I want to buy a put on RY to cover the risk of a stock going down versus XTKS. David, I'm not sure I understand your question. If you don't mind clarifying, I'm happy to answer that question. What's a trailing stop? Trailing stop is a type of order that basically moves the limit price up every single time the order goes up. Eileen, I just recommend you Google trailing stop is the best way to learn more about it. Should I be concerned about trading options that have no volume? So generally speaking, my answer is no. If it's on the liquidity list, you don't have to worry about liquidity. Volume and open interest just tells you if someone else trades it. What does that have to do with you trading it? Market makers are there, they're making liquidity, that's their job. As long as there's quotes and the quotes are tight, you should trade it. Doesn't matter if someone else traded or not. And especially now that they're listing thousands of strikes, so sometimes they just list crazy amounts of strikes. So guess what? Naturally, open interest and volume are just going to spread out across a larger group of options. So you naturally have lower open interest and lower volume across each individual strike. If you want to look at volume, don't look at the volume of an individual strike price. Look at the volume of the whole option series. So for example, even on something as liquid as, let's say, BMO, which is one of the most liquid options that you can trade in Canada, so Bank of Montreal, notice how there are plenty of strikes that have zero open interest. But if you look at the whole volume, if you look at the whole strike, there are thousands and thousands of contracts available for open interest. But does that mean that this one strike has less liquidity? A market maker doesn't care if he's making a market in the 80.5 strike versus a 78.5 strike. There's no difference to a market maker from a liquidity perspective. So a lot of investors will say, oh, this has zero open interest and volume, and they won't trade it, not understanding how this all works. And they somehow will trade the 78.5. The 78.5, I can tell you, is not any more or less liquid than the 80.5. They have the exact same liquidity because a market maker is simply going to buy and sell the underlying stock in order to hedge their portfolio. As long as the stock is liquid, they will hedge their positions regardless of whether they're making market in this strike or another strike that has 1,000 open interest like this one. You know, it doesn't matter to the market maker. So hopefully this gives you a little bit more insight into how liquidity actually works. And maybe this gives you a little bit more confidence in placing your orders when you see that low open interest and volume that, from my perspective, I see a lot of retail investors hesitate to trade because of that. Sebastian is saying, let's say I buy a leap call and then continuously sell calls with shorter expiration dates. How can I cover my short with my long positions? Can I cover my short and my long positions if I get a sign and I can execute my leap against assignment? Sebastian, you can exercise your long leap to cover your short exercise, but I don't recommend it because when you exercise your long call, you've given up all of that extrinsic value. You're better off selling your long call, taking the proceeds of that, and then satisfying the short call, or simply buy back the stock. You know, you don't have to, you know, just because you got a sign on the short call doesn't mean that you have to exercise your long call. I actually encourage you, don't exercise your long call because you are giving up free money when you exercise your long leap. Julie is saying, if the underlying stock price isn't moving, then the bid-ask stays fairly constant. That is correct. If the underlying stock price isn't moving, then you shouldn't expect to see a very large move in the option price. You might see it tick down by a couple of pennies, you know, throughout the day, of maybe 5 or 10 cents throughout the day, but you should not see a big move in the underlying option price. Affected by time and IV. That's correct. But, you know, time and IV are relatively small exposures compared to delta. So underlying stock price is always going to have the largest effect on the value of your option. Do stocks have implied volatility like options? No, only options have implied volatility. Stocks have historical volatility, but only options have implied volatility. And implied volatility is just what the options are implying, what the future what the market is expecting future volatility to be. But that's still volatility of the underlying stock. How can I tell if an option is cheap or expensive? So Jonathan, one of the things that we created was the OptionsPlay score. The OptionsPlay score gives you a sense for whether what you're buying or selling is cheap or expensive. So here, paying 37 cents for a $5 by $6 wide put vertical here, paying 37 cents is relatively cheap for that put option. It's a little cheaper than 46 cents for just a straight put. But even the 46 straight put is an average, I would say, cheapness, if you will. That's why it's got a yellow OptionsPlay score. The green OptionsPlay score tells me that this put is fairly cheap because I'm only paying 37 cents on something that probably moves quite a bit. As you can see, this stock moved from $7 down to a little over under $5 in just a few days. So if I'm paying 37 cents all the way out to November, that's relatively cheap. So that's how we created the OptionsPlay scores, to give you a better sense for that. Boris is saying, when you say work the price, does that mean you stay on it and make changes until it trades? Yes. So if I place this order here at 37 cents, I'm buying it. Let's say I place my order at 35 cents. I'll see if I can get filled. If not, I'll move it to, let's say, 36 cents. And if I still don't get filled, then I'll place my order at 37 cents. Now, this is an example where the markup is pretty small to begin with, so there's not a whole lot to work with. But if, let's say, I'm trading something like, let's take a higher price stock like SAP, and let's say I'm buying this put option. Here, you know, also not a whole lot of markup here. I can either start at 145, move it up to 150, and then probably move it up to 155. So it really just, but that's what I mean by working your order, is to just change the price of your option until you get filled. Okay, that covers what I wanted to share with you here today. And the questions, any last questions? Raymond, you're very welcome. Thank you so much for participating. I really appreciate you taking the time out here today. Again, to register for a free account here at OptionsPlay, all you have to do is sign up using this link here on your screen, optionsplay.com/TMX. We'll send you both the recording and the slides so that you can follow along. So if you want a copy of these slides or the links, we'll send that to you as soon as we finish here today. With that, thank you so much. I hope that you guys have a great afternoon, and I'll see you guys here in a couple of weeks. Have a great evening and happy trading.